Good morning. Well, what another night. It's kind of fun to watch, really, when you think about it. As currency traders, we like this kind of volatility. We live for it, and whilst the moral and financial implosion and the moral view of it that everyone's going to be out of work, it's not great. Currency trading is recession proof. As long as the markets are moving, there's opportunity. What currency traders don't want is markets just treading water going sideways, and that's certainly not happening today or overnight. There was little in the way of news in terms of economic data releases, but there was certainly news in Credit Suisse, which is a massive institution, global institution with offices in nearly every major city around the world. And whilst they're not broke, they're getting close to it. There's been a run on their funds, so built a reputation. They only make scandals in public, hard to comprehend. Snowballed, its shares slumped. What went wrong? Criminal conviction for allowing drug dealers. Mozambique corruption. Failed New York investment, and clients voted, leading to unprecedented client outflows. That was the start of it. But then there was a bit more of it as the SVB failed and risky investors began selling the stock, and funds started to disappear. So, as these guys say in the Fin Review, it was a truly scary night. How many times can you play whack-a-mole if all these major institutions, including this one of the largest banks in the world, having issues and needing to be bailed out by the SFMS, saying that whilst the bank meets higher capital and liquidity requirements, it will provide liquidity to the global banking if necessary. So on one hand they're saying it's all good, but on the other hand they're saying we'll bail them out. So this chart, that's fun. So that's CDSs on the credit defaults, swaps on Swiss, the Credit Suisse. So that's just exploded, massive, and this is the share price. As you can see, it's just been massively sold off over the last 2 or 3 years as stocks disappear. Rather than trying to explain everything, I'll just go through Tyler Durden's wrap, as it sort of neatly says everything I want to say anyway. So American deposit receipts on the Credit Suisse, there's a 5-minute chart, got smashed from the open, probably bounced on the FINMA and SMB, that's these guys that we're talking about, and then decided to sell off again. So European stocks smashed, down 15% in the last week. Credit risk, European credit risk is skyrocketing. German bonds crashed, most on record. Big move in the bonds. The market expectations, the ECB's meeting tomorrow night, Thursday night, tonight, in Australia, and plummeted from 100% chance of a 50 basis point hike a week ago to barely a 25 basis hike. And that de-risking is spreading around the world, dragging US stocks and bonds lower, dollar higher. US equities plunged 2% on Credit Suisse Contagion. Then when the Swiss authorities became involved, panic buying, but then it sort of faded into the close. And regional banks in the US extended losses today since the bailout on the weekend. This is the regional banks performance. It's all pretty scary stuff. Treasury yields, or Treasury's bid on safe haven flows, i.e. the yield is getting sold off, bonds going up, yields go down. So as they buy bonds, the yields go down. So yesterday, bonds had bounced, but then got sold off today. So the contagion and risk of a recession is still real, right? Even though the central banks, obviously now Swiss central bank and the US central bank are in bailout mode. The recession, there's still going to be a recession. You think back in 2008, they bailed everything out and they still went through a recession. And that's when quantitative easing came in to try and spur growth. And to me, quantitative easing is an evil tool that just shifts wealth from the middle and lower classes to the upper classes. Right, so 2-year yield crashed back below 4%, 10-year yield back below its 200-day moving average. That's the 10-year yield there that we're looking at. And then further on, we've got this is the 230s curve, which is the recession indicator, and when it starts to go positive, that's recession's pretty much on your doorstep. Rate hike expectations, 100 basis points by year end, so another 1%. Is now saying that's a coin cost between next week between being no rate rise to 25 basis point move up, and the path has seriously dropped, signalling a panic series of rate cuts coming. Before we leave the bond land, the 6-month interest yield has topped the S&P 500 earnings yield for the first time in 11 years or 12 years, and then things started to get a bit nasty. US dollar saw safe haven flows. We'll go through the charts in a minute, see if there's opportunities there, because we're still well, I don't know where to be with the US. And I said this I think yesterday, where it's going to be tricky going forward, because it looks like the US interest rates aren't going to be going to 6% as expected. But the rise in the US dollar has been on the back of 2 reasons. One, that you've got interest rates rising, and 2, you've got safe haven flow, right? So this has been interest rate rising, and then it's the Powell pivot that everything's going to be okay as inflation started to peel off. But then the inflation wasn't peeling off, and we're also getting that safe haven bid as well. And you were getting safe haven bid through there as well a little bit, as the Nasdaq, also as the stock market has been weakening through that time. So you're also getting the safe haven bid. So there's that dual prong for the US dollar, but now it's sort of either one or the other. It's either interest rates are going down and not supportive of the US dollar, or you've got that safe haven flow and is supportive. So it's going to be a bit tricky to try and get a long-term direction on the US dollar. Bitcoin off a little, still up. Oil absolutely smashed, and most of the commodities are also weaker. Copper also smashed. Gold obviously safe haven, and systematic risk indicators are flashing red. So fun times. Love seeing markets like this. Always enjoy massive movements as portfolios are trying to rebalance and protect against downside. But let's go through the majors. Aussie dollar. With commodities coming off, I really don't want to be long Aussie. I think I said earlier that there's a good sell there on the 4-hour off 67 cents, and that's proved to be the case right now. Shorter time frames, probably not ideal, but yeah, I'd still prefer to be short this. Euro dollar, absolutely smoked, and I prefer to be short that too. in the sort of over the coming days to a couple of weeks. I think that's where you want to be, as there's going to be more bad news as we go along. The idea that it's all over now, I don't think so. We've got there's going to be more companies hitting the wall, and that's going to be bad news, and therefore US dollar will be the go-to along with the yen. And speaking of that, so your battle of where do you want to park your money? Do you want to park it in the US or do you want to park it in Japan? And it's a bit choppy and hard to predict that, but if you go and look at the yen crosses, that's where you might find good opportunities selling, like the euro yen, selling Aussie yen, Kiwi yen, any of the weaker currencies you want to sell against a strong currency. So yen being a stronger one right now because of that safe haven flow. Well, what a day. I think tomorrow's going to even be more fun. There's as we said, there's some news out tonight from the ECB. What will they do? Where will they? How much? The market's still pricing in half a basis point, but might not get that. Yeah. And then next week we've got the FOMC. So good times for short-term traders. There's a lot of opportunity there. You just got to get on the right side of it. So stay safe and best of luck.